So you're thinking about getting index universal life insurance, but you don't know where to start. In today's video, I'll give you a brief overview on what to look for in a carrier, a product, and an advisor. Hey folks, I'm David McKnight, best-selling author of The Power of Zero. Today we're going to talk about the IUL trifecta, how to find the right carrier, the right product, and the right advisor. Let's start with how to find the right carrier. Let me begin by warning that all good IULs are sponsored by financially stable life insurance companies, but not all financially stable life insurance companies offer good IULs. In other words, you can have an IUL that possesses all of the right attributes I'll be discussing later, but if it's sponsored by a financially unstable company, then it's all for naught. After all, if your IUL company goes broke, who cares about guarantees they can no longer honor? On the flip side, you could have an extremely financially stable life insurance company that offers an IUL with all the wrong attributes. So, for starters, what we're looking for in an IUL carrier is financial stability. It's got to be rock solid. So how do we judge whether a life insurance company is truly rock solid? Well, there are four main organizations that rate life insurance companies: Moody's, Standard & Poor's, AM Best, and Fitch. The problem is they each have their own methods of rating insurance companies, and making heads or tails of their rankings can sometimes be confusing. For example, an A+ rating with AM Best is the second best rating, but with Standard & Poor's or Fitch, an A+ is the fifth best rating. For that reason, I prefer an independent ranking service known as Comdex. Comdex averages the rankings of the aforementioned companies and comes up with a composite score of anywhere from 1 to 100. This ranking works a little like those tests we used to take back in high school. Remember when they said you were in the 92nd percentile in math? That basically meant that you were in the top 8% of the students. In other words, your math proficiency was better than 92% of your peers. Well, the same holds true with the Comdex ranking system. If the Comdex score of a life insurance company is 90, then it's more financially stable than 90% of the life insurance companies in the industry. Given what I've seen with life insurance companies over the years, it's critical that you limit your search to IUL companies that have a Comdex rating of 90 or better. All right, now that we've established that not all life insurance carriers are created equal, now I'm going to show you that not all IULs are created equal either. There are actually 25 different qualities you should be looking for in an IUL, but today I'm going to focus on what I think are the 5 most important attributes. Now, I go into each of these in much deeper detail in my video, The 5 Things Your LIRP Must Have, which I've linked in the description below, but here is a brief overview. First, a guaranteed 0% loan provision. One of the huge benefits of the IUL is that your money grows tax-free and you can take it out tax-free. You do so by way of a loan. If you find the right IUL carrier, you can get what's called a guaranteed zero-wash loan. That means that they charge you money for taking your loan, let's call it 3%, but they credit that same 3% right back to you. And if they guarantee that neither of those numbers can change, there will never be any cost for taking that policy loan. In other words, if you find the right carrier, your distributions from that IUL can be both tax-free and cost-free. Insist on having this provision in your IUL. Second, interest in arrears. Okay, remember that you get money tax-free from your IUL by way of a loan. They charge you a rate of interest, say 3%, and they credit that same 3% right back to you. Well, they can charge you that 3% interest in 2 different ways, either in advance at the beginning of the year or in arrears, which is at the end of the year. If your IUL charges interest in advance, then you'll have less money working for you over the course of that year, and this can produce a drag on your cash value over time. So even if you have a guaranteed 0% loan, if it's interest in advance, add an additional 0.4% to the cost of that loan. If it's interest in arrears, conversely, then you're experiencing a true guaranteed 0% loan. 3, daily sweeps. Okay, what's a sweep and what does it have to do with your IUL? Well, when you contribute money to your IUL, it gets deposited into an account where it earns a nominal rate of interest. Your money won't actually go to work until that insurance company sweeps it out of that nominal interest rate account and into that growth account. Here's the problem. Some companies are so small that they have to wait anywhere from 3 to 6 months to pool up enough assets to where it's cost effective enough to purchase the options required to make those assets grow. So what's the problem with this approach? Well, it once again comes down to opportunity cost. If every time you make a contribution to your IUL, your premium sits around languishing at a nominal interest rate for 3 to 6 months before getting swept into the growth account, there's an opportunity cost associated with that. You're missing out on the growth of that money for 3 to 6 months. And if you amortize that inefficiency out over the life of your IUL, which in some cases can be 50 years or longer, then that can have a huge drag on your cash value. So in a perfect world, you should insist on daily sweeps. By the way, weekly sweeps, while not perfect, are also acceptable. 4, an over loan protection rider. Through a combination of mismanagement of loans, policy underfunding, fees, or poor performance, your contract could run out of cash value. And guess what? If your cash value goes to 0 before you die, all the tax savings you experienced over the life of the policy to that point all come due all in 1 year. That's right, you'll receive a massive 1099 from the IRS in the year your policy runs out of cash. So to forestall this outcome, you must insist that your policy have an over loan protection rider. This means that when your cash value drops to a certain point, the insurance company will give you the option of essentially taking over the policy. They will reduce your policy's death benefit to the point where the remaining cash value essentially pays the policy up. And whatever death benefit remains is what gets passed on to your heirs. And while this does prevent you from being able to take out any more loans, it protects you from having to receive that devastating tax bill from the IRS. So you must insist that your LIRP have this important feature. 5, a chronic illness rider. With a chronic illness rider, the insurance company gives you the ability to receive your death benefit in advance of your death for the purpose of paying for long-term care. Here's an example. Let's say you have a death benefit of $400,000. You wake up one day and can no longer feed yourself, bathe yourself, transfer yourself, what have you, and you can find one doctor to write one letter to that effect. The insurance company will send you 25% of your death benefit per year, or in this case, $100,000 per year, every year for 4 years for the purpose of paying for long-term care. Now, they may discount that $100,000 based on the age in which you received the benefit, but the point is this: they're willing to give you your death benefit in advance of your death for the purpose of paying for long-term care. And should you die peaceful in your sleep 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably your kids or your grandkids. So there's that sensation of having paid for something you hope you never have to use. Okay, we've talked about what to look for in an IUL carrier. We've talked about what to look for in the IUL itself, but how about an advisor? Well, there are 3 things I want you to look for in an advisor. First, do they hold the IUL out as a silver bullet? Remember, the IUL has attributes that do make it unique. And when positioned properly, it can be an important facet of a comprehensive, balanced approach to tax-free retirement planning. However, if your advisor also sings the praises of Roth IRAs, Roth 401ks, and Roth conversions, then you know they have a realistic view of the proper role IUL can play in a balanced approach to tax-free retirement. If conversely you find them constantly debasing the Roth IRA or Roth 401k in an effort to exalt the IUL, then that's a sure tell sign they belong to the IUL as a silver bullet fan club. Second, do they make unrealistic claims about the IUL? Here are just 2 of many claims you need to watch out for. First, the IUL will beat the stock market. I often see agents on TikTok claiming an IUL can earn 15% over a 20 to 30 year time period. The IUL, therefore, is a suitable substitute for stock market investing. This is hogwash. Avoid these advisors at all costs. The IUL can realistically return 5 to 7% net of fees over time. It is therefore much better understood as an effective bond alternative. Second, IULs can't lose money. If they tell you that IULs can't lose money, this betrays a lack of understanding around how the IUL actually works. Truth is, if the index goes down and you get credited a 0, you will still pay administrative fees and the cost of insurance. So yes, IULs can lose money. It's important that your advisor be able to describe the limitations of the IUL in an honest and straightforward way. Third, drill your would-be advisor on the must-have IUL attributes I discussed in this video. Ask them about the implications of monthly sweeps or interest in advance. If the responses reflect an understanding of how IULs really work and why these must-have attributes are important, then that's certainly a point in their favor. In summary, not all IUL carriers are created equal. Not all IUL products are created equal, and not all financial advisors who offer IULs are created equal. The IUL is a long-term contractual relationship, and it's critically important that you get all three of these things right before you enter into the contract. If you want to learn more about how to find the right IUL carrier, product, or advisor, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And then don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.